You know, usually when we talk about a financial audit or like looking at a company's balance sheet, there's this expectation of, I guess, mechanical precision.
Right, yeah. Like everything is perfectly categorized.
Exactly. You check the bank account, the statement shows that solid black number, and the auditor just sort of points and says, you know, there it is. Money is there or money is not there.
It feels incredibly binary. We definitely like our financial realities to be highly visible, you know?
Oh,
It
absolutely.
gives us this false sense of security when we can look at a spreadsheet and just see these neat little rows and columns that balance out to the penny. But the reality of modern corporate finance is, well, it's far removed from that kind of simplistic bookkeeping.
Which honestly brings us right to the actual framework of modern accounting standards.
Oh,
Specifically, when you step into the world of expected credit losses.
oh yeah, that changes everything.
It really does. Suddenly, that simple bank statement starts to look more like an optical illusion. You end up looking at a financial landscape that is incredibly murky.
Where a number on a page might not actually represent the economic reality of the situation at all.
Right. And that is exactly why I'm so thrilled to welcome you, the listener, to a brand new deep dive right here on the Gap Advisors and ADIS Clinic podcast.
It's such a critical topic to dissect today. I mean,
Yeah.
the gap between what a number looks like and what it actually means is where all the risk lives.
Yeah, let me set the context for you. Whether you are a seasoned finance professional gearing up for, the grueling audit season, or you're just an everyday investor wanting to understand where your hard-earned money is actually going, you are exactly in the right place.
Because if you're putting your money in shares of a listed company, you desperately need to understand these accounting standards.
You really do. I mean, think about the mechanics of a business, right?
Yeah.
If a company's balance sheet claims they are owed millions of rupees, and they show that as a massive, healthy asset.
But those debts are highly unlikely to actually be paid on time.
Exactly. Or maybe they won't be paid at all.
Yeah.
Then that company's real value is like artificially inflated.
It's essentially a balloon waiting to pop.
Right. So understanding the specific accounting standards that govern these valuations is basically your personal shield against some very nasty financial surprises.
And that shield is built entirely out of transparency and really rigorous methodology. And what we are looking at today is perhaps one of the most striking examples of how that shield functions in practice.
Yeah, and we should mention where we got this stuff. When we were preparing for this, we pulled our source material directly from the incredibly robust issue repository over on gapadvisors.com.
Which is just a fantastic resource.
It is. I spent some time digging through that repository. And the sheer volume of, practical real-world application data is staggering. I think they have over 4,500 issues there.
Over 4,500, yeah. And they're highly detailed responses, specifically dealing with Ind AS and Indian GAAP.
Yeah, it reads less like a theoretical textbook
Yeah.
and much more like a battlefield manual for auditors and CFOs.
A battlefield manual is the perfect way to describe it. I mean, the complexity of applying Ind AS to corporate transactions requires that level of granular documentation.
For sure.
And the platform is structured so that literally any person can register for free, which is huge, and submit their own highly specific issues regarding Ind AS and Indian GAAP.
And then the responses are, meticulously researched and delivered directly to the inbox of the email you registered with, right?
Exactly. So for auditors who are staring down a complex transaction and need ironclad, verifiable documentation on exactly how they addressed an Ind AS application issue.
It's an absolute lifeline.
It really is. It provides the rationale and the specific standard citations necessary to defend an audit position.
It takes the guesswork completely out of the equation. And for our specific journey today, we are unpacking an issue that was featured in the 216th edition of the Gap Advisors Tasked Weekly newsletter.
Yes, authored by C.A. Manish C. Iyer, the director of GAP Advisors.
Right, and he publishes that regularly on LinkedIn. Just to give you a sense of the consistency and the depth of the archive here, there have been over 230 editions published to date.
The consistency is key, because the standards are always evolving in their application. And I should note, for anyone dealing with really bespoke or thorny issues in their own corporate reporting, you can actually book a one-on-one consultation.
Oh, wow, really?
Yeah, regarding your specific issues on Ind AS and IFRS directly with the author, you can find his booking page over on topmate.io.
That's incredibly useful. When you are stuck on a nuanced interpretation, Sometimes you just need to cut through the noise and speak directly to an expert who spends all day in the trenches of these standards.
Absolutely. Now, before we really roll up our sleeves and, get our hands dirty with the numbers and the risk models, we need to establish the structural ground rules for this deep dive.
Oh, yes, the disclaimers. Let's
hmm
lay the foundation. So the specific response and the granular analysis we're going to explore are given strictly under the Ind AS framework.
However, and this is a vital point for our international listeners, there is absolutely no difference between Ind AS and IFRS for the specific topic of financial instruments and expected credit losses that we're discussing today.
So this entire discussion can be applied by all entities globally that are following the IFRS framework.
Exactly. The underlying logic, the mathematics, the regulatory intent, they are identical.
Well, that broadens the scope significantly. We also need to set the stage regarding the financial calendar and the currency we're operating in.
Right. For the sake of our specific examples and the calculations we'll run through, the functional and presentation currency is the Indian rupee, or INR.
And any currency other than this functional currency is considered a foreign currency, which carries its own set of translation risks that we won't really detour into today.
Right. We'd be here all week. Furthermore, the beginning of the reporting period we are talking about is always the 1st of April, and the end of that reporting period is the 31st of March.
Okay, that gives us our temporal and financial boundaries. And there is one final mandatory piece of housekeeping we got to cover.
Yes, the legal bit.
The views expressed herein are the personal views of the author and are not binding on the audience. You, as the listener, are strongly requested to seek the help of a qualified expert before taking any action or, refraining from any action based on the views discussed in our analysis today.
Excellent.
Okay, let's unpack this. Here is the mission we are tackling today. We have a corporate entity. Let's call them a solid, functioning, highly profitable company. Okay?
Painting the picture.
And they are holding a significant portfolio of assets on their balance sheet. But I want to be super clear about the nature of these assets. These aren't highly volatile tech stocks.
They aren't speculative cryptocurrency plays or anything like that.
No, not at all. They aren't unrated junk bonds. These are what most people, and indeed this specific company's management team, would consider incredibly, unequivocally safe assets.
Right, the rock-solid stuff.
Yeah. And the management team has posed a seemingly logical question. Under the rigorous requirements of Ind AS 109, do we really need to calculate and provide an expected credit loss or an ECL allowance on these practically risk-free amounts?
It is a question that arises constantly in boardrooms because it represents a massive friction point between everyday common sense and strict accounting reality.
Oh, I bet.
The management team is looking at their portfolio and thinking, well, we are not going to lose this money. Why are we being forced to pretend that we might?
I think the listener is going to immediately sympathize with the company's position once we detail exactly what is in this portfolio.
Yeah.
Let me just read off the 5 specific categories of assets they're asking about.
Go for it.
Number 1, term deposits. So these are essentially fixed deposits held at major regulated banks, locked in for a duration of 1 to 3 years.
Very safe.
Number 2, treasury bills, which are short-term government debt instruments. Number 3, debts owed by their own group companies, so subsidiaries or sister entities under their corporate umbrella.
Still in the family, right?
Exactly. Number 4, debts owed by government companies. And number 5, secured debtors or secured loans, meaning loans that are explicitly backed by physical collateral, like, say, real estate or heavy machinery.
If you were to ask a layperson to construct a conservative capital preservation portfolio, that list is exactly what they would come up with.
100%.
I mean, the perceived risk of default on those instruments approaches zero in the minds of most corporate treasurers.
So let me play the role of the skeptical, slightly annoyed chief financial officer here.
I love when you do this. Put the hat on.
Got the hat on. Look, if I have my corporate cash sitting in a fixed deposit at a systematically important national bank, or I hold a treasury bill, which is literally backed by the sovereign state that prints the currency.
Right, the people who make the money.
Yeah. Or I am owed money by a government-owned enterprise. Or let's say I gave a loan, but I physically hold the deed to the borrower's factory, which is worth twice the loan amount.
Okay, I hear you.
Why on earth would I ever expect a credit loss? Forcing my accounting team to spend hours modeling an expected credit loss allowance on these items feels completely redundant.
It feels like unnecessary homework.
It feels like wearing a life jacket in a puddle. Why am I being forced to build an ark when there is not a single cloud in the sky?
The frustration from your hypothetical CFO is, it's entirely understandable, but it stems from a colloquial definition of risk.
What do you mean by colloquial?
Well, when a treasurer says risk-free in a management meeting, they usually mean, I am highly confident we won't face a catastrophic loss of principal.
Like, I'm not going to lose the main chunk of money.
Exactly. But Ind AS 109 introduces a massive, uncompromising paradigm shift. The standard does not care whether an asset feels safe in the emotional or conversational sense.
It doesn't care about my feelings?
Not even a little bit. It demands adherence to a universal mathematical framework of expectation.
A mathematical framework of expectation. So you're saying the standard separates the psychological comfort of holding a government bond from the mathematical reality of holding any financial instrument over a period of time.
Precisely. To understand this, we really have to look at the history. I mean, Ind AS 109 completely overhauled how the corporate world looks at financial instruments.
Because it used to be different, right?
Totally different. We moved away from what was called the incurred loss model. Under the old rules, you only recognized a loss on your balance sheet when a trigger event actually occurred, when something went bad.
Like actually went bad in reality.
Yeah. If a debtor missed 3 payments or filed for bankruptcy, then, and only then, you recorded the loss.
Which seems incredibly reactive. If you think about it, you're telling the investors about the fire after the building has already burned down.
It was incredibly reactive, and the 2008 global financial crisis proved that it was dangerously inadequate.
Oh, right, because all those toxic assets looked fine until they suddenly didn't.
Exactly. So the regulators shifted to the expected credit loss model. This model forces entities to look forward. It demands that you recognize the inherent credit risk from the very first day you originate or purchase a financial asset.
From day one.
Day one. And to your CFO persona, I would challenge that notion of absolute certainty. Just imagine you lend a substantial amount of money to your most reliable, trustworthy, highly successful business partner.
Okay, my best partner.
They sign a contract promising to pay you back in exactly 1 year. From your perspective, that is a perfectly secure loan. But if we run a statistical simulation of 1 million identical loans to perfectly reliable partners, is there truly mathematically zero risk of them paying you a week late?
Well, no. I mean, if I think about the logistics, maybe their primary bank experience is a massive IT outage on the day the wire transfer is supposed to clear.
Right.
Or maybe the partner is traveling internationally and just misses the cutoff time for the transfer. Or there's a sudden temporary regulatory freeze on their account.
Exactly. That slight delay, that tiny fraction of a percentage of probability that the transaction does not execute perfectly according to the exact contractual timeline.
That's the risk.
That is the microscopic risk that an AS 109 is hunting for. The standard insists that safe does not equal risk-free. As long as there is a time horizon between today and the day you are contractually owed cash, there is a probability distribution of outcomes.
Wow. So even the most ironclad contract in the world, backed by the most reliable institution, possesses a non-zero probability of deviating from the plan.
Unavoidably.
And Ind AS 109 demands that we mathematically account for that non-zero chance, no matter how vanishingly small it appears to the naked eye.
It is an inescapable mandate. The core directive in the response we are analyzing today is unequivocal. A company must recognize a loss allowance for expected credit losses on financial assets that meet specific criteria.
It's not optional.
It is absolutely not optional based on how comfortable management feels about the asset's pedigree.
All right, let's dig into those specific criteria then, because the source document gets into the regulatory weeds very quickly here.
It does get a bit dense.
Yeah, it states that you need to establish this loss allowance on a financial asset that has contractual terms giving rise to cash flows on specified dates that are, and I'm quoting here, solely payments of principal and interest on the principal amount outstanding.
Yes, the famous SPPI test.
Right, and because they meet that criteria, they are subsequently measured at either amortized cost or at fair value through other comprehensive income.
That is a massive mouthful of accounting jargon, I know.
It really is.
Yeah.
What does it actually mean, mechanically, to have cash flows that are solely payments of principal and interest?
Well, the SPTI test is arguably the most critical gateway in the entire Ind AS 109 framework. It dictates exactly how an asset is classified and measured.
So we should probably deconstruct the components then.
Let's do that, because the standard defines principal and interest in highly specific ways that differ significantly from how we use those terms at the dinner table or even in basic retail banking.
Okay, hit me. First, let's look at principal.
Under the standard, the principal is defined as the fair value of the financial asset at initial recognition.
Wait, let me make sure I'm wrapping my head around this. So it's not just the face value of the amount I lent?
Not necessarily, no.
It's the actual calculated fair value of that asset on day one. So if I buy a bond at a premium or a discount in the secondary market, my principal for this test is what I actually paid for it, not what the bond says on its face.
That is correct. The principal amount can actually change over the life of the financial asset, too. For example, if there are repayments of principal along the way.
Got it. Okay, now let's tackle interest. Because in our daily lives, we think of interest simply as the bank's profit,
Right.
right? Or the nominal cost of borrowing money.
Right, the extra bit you pay for the privilege of the loan. But Ind AS 109 unpacks interest into a bundle of specific compensations. Yeah. It defines interest as the consideration for the time value of money, for the credit risk associated with the principal amount outstanding during a particular period, and for other basic lending risks.
Like liquidity risk.
Exactly. Liquidity risk and administrative costs, plus a reasonable profit margin.
That is a much more layered definition. It means when I receive an interest payment, I'm not just getting one monolithic thing. I am receiving a bundled payment.
You're being compensated for multiple factors.
Right, so I am being compensated because I do not have access to my cash today. That's the time value of money. I am being compensated because there is a statistical risk you won't pay me back. That's the credit risk premium.
Yes.
I am being compensated because my money is tied up and I can't use it for emergencies liquidity risk. And I am being compensated for the operational headache of managing the loan paperwork.
Administrative costs.
All of those specific elements must be present, and nothing else, for a payment to qualify as interest under the SPPI test.
That breakdown is spot on. If we elevate this to the strategic level, the SDPI test is basically asking a fundamental question. Is this instrument a basic, straightforward lending arrangement? Are the cash flows entirely predictable and tied exclusively to the economics of lending money?
Okay, let me test that logic by constructing a scenario. If I'm looking at SPPI, to me that sounds like a standard fixed-rate corporate bond.
Okay, let's hear it.
I buy the bond, the corporation pays me a fixed 7% coupon every single year for 5 years, and at the end of year 5, they hand me back the face value.
Very standard.
Right. The cash flows occur on specified dates, and they consist solely of getting my original value back, plus that bundled compensation for time, credit risk, and liquidity. Does that pass the SPPI test?
It passes the SPPI test effortlessly. That is the very definition of a basic lending arrangement.
Okay, so what would cause an asset to fail the test? Give me an example of something that looks like a loan but breaks the rules of SPPA.
Well, let's introduce a complication. Imagine your company purchases a convertible bond. It pays a nominal interest rate, but the contractual terms state that the interest payments are linked to the performance of the borrowing company's equity shares.
Oh, interesting.
Right, so if their stock price doubles over the next year, your interest payment doubles. If the stock price crashes, your interest payment drops to zero.
Ah, I see the problem. In that scenario, the cash flows I am receiving are no longer just compensation for the time value of money and basic credit risk. My return is now heavily exposed to equity price risk.
Exactly.
I am essentially gambling on their stock price while pretending to hold a bond.
Precisely. Because the cash flows are exposed to risks that are unrelated to a basic lending arrangement, the instrument fails the requirement that the cash flows are solely payments of principal and interest.
It fails the SPPI test.
It fails. And when an instrument fails that test, it gets ejected from the standard lending categories and is thrown into a completely different accounting classification. Typically fair value through profit or loss or FVTPL, that category has its own incredibly complex set of rules requiring constant market valuation, and it entirely bypasses the standard amortized cost ECL model we are discussing today.
Wow, okay, that makes perfect sense. So returning to our hypothetical CFO's list of safe assets, the fixed deposits at the bank, the treasury bills, the standard loans to group companies and government entities, assuming these don't have any bizarre equity kickers or weird derivative features embedded in them, these are all basic lending arrangements.
Right, you lend the cash, you get it back on a specific date with a standard market-reflective interest rate.
So they pass the SPPI test.
They absolutely pass. And because they pass the SPPI test in AS 109 mandates, that they fall into one of two specific measurement categories that require the calculation of an expected credit loss allowance.
Okay, and the first category is amortized cost, right? Which is detailed thoroughly in paragraph 4.1.2 of the standard.
That's right.
The source material notes that amortized cost is strictly for assets held within a business model whose objective is to hold financial assets in order to collect contractual cash flows.
Let's translate that into treasury behavior because it can sound a bit abstract. Think of it as the buy and hold until maturity strategy.
Buy and hold.
Right. The company purchased that 3-year fixed deposit with the sole intention of leaving it at the bank for 36 months, collecting the quarterly interest, and taking the principal back at the end.
They aren't trying to trade it.
Exactly. They have no intention of trading that deposit on an open secondary market to capture short-term price fluctuations.
Okay, and the second category the standard mentions is fair value through other comprehensive income, or FVOCI, which is governed by paragraph 4.1.2a.
This category introduces a slight pivot in the business model. This is for assets held in a business model whose objective is achieved by both collecting contractual cash flows and selling the financial assets.
Both collecting and selling.
Yeah. For example, a corporate treasury department might purchase a massive block of 10-year treasury bills. Their primary goal is to collect the steady, sovereign-backed interest.
Sure.
However, if macroeconomic conditions change, say, central bank interest rates drop sharply, which causes the market value of those existing treasury bills to smite, the treasury team might decide to sell those bills early to lock in a significant capital gain.
So it's a dual-purpose strategy. You hold it for the yield, but you keep your finger hovering over the sell button if the market offers you a premium.
Exactly right. And the overarching rule here is that regardless of whether your business model is purely buy and hold under amortized cost, or hold but potentially sell under FVOCI, Ind AS 109 dictates that you are exposed to credit risk every single day you hold that asset.
And therefore, you must calculate and record an ECL.
You must.
I'm looking at the source text, and it's clear this standard casts an incredibly wide net over traditional financial instruments. But it doesn't stop there, does it?
No, it doesn't.
The response specifically notes that under paragraph 5.5.1 of Ind AS 109, these impairment requirements, this strict mandate to calculate a mathematical expected credit loss, explicitly bleeds over into two other massive, complex areas of the balance sheet governed by entirely different standards.
This is a critical juncture that frequently catches corporate accounting teams off guard.
I can imagine.
The impairment requirements of Ind AS 109 actively reach out and pull in lease receivables that are recognized under Ind AS 116, which is the comprehensive standard for leases.
Let's ground that in a practical scenario, just to make sure I'm following. Suppose my company manufactures heavy mining excavators, right?
Okay, big, expensive machines.
Huge. And instead of selling them outright, we enter into a 5-year finance lease with a major mining conglomerate. They pay us a fixed amount every month for 5 years.
Standard lease arrangement?
So the money they owe me over the duration of that lease, are you saying I have to build an expected credit loss model for those lease payments exactly as if I were a commercial bank extending them a corporate loan?
You do. Because from an economic standpoint, the substance of a finance lease is almost indistinguishable from a loan. You have provided them with an asset of significant value, and you are extending them credit over a 5-year horizon.
I guess that's true. They get the machine now, I get the money later.
Exactly. The mining company could face a strike, commodity prices could crash, they could default on their payments. TS 109 recognizes that the credit risk is identical to a loan, and therefore, the lease receivable is subject to the exact same rigorous ECL calculation.
That significantly complicates lease accounting. And the second major area the standard ropes in relates to revenue. It brings in contract assets recognized under Ind AS 115, which is the standard dealing with revenue from contracts with customers.
This one is perhaps even more pervasive than the lease receivables. In AS 115 deals with the timing of when a company is allowed to recognize revenue.
I can visualize this perfectly. Let's say I run an enterprise software consulting firm. We sign a massive multi-million rupee contract to overhaul a client's entire back-end infrastructure over 18 months.
A huge project.
Yeah. By month 6, we have completed a major complex milestone. Under the rules of Ind AS 115, we're allowed to recognize the revenue for the work we've completed, right?
Correct.
But according to the specific payment terms in the contract we signed, we cannot actually issue an invoice to the client until the 12-month mark.
The delay.
So on my balance sheet, I don't have an accounts receivable yet. I have a contract asset representing the unbilled revenue for the work I've successfully delivered.
Yes.
Are you telling me that I have to calculate an expected credit loss on revenue that I haven't even been allowed to bill yet?
I am telling you exactly that.
That is wild.
If you have recognized a contract asset on your balance sheet, you have inherently accepted credit risk. You have performed the service, you have recognized the value, but you have not collected the cash.
And a lot can happen between month 6 and month 12.
Exactly. What happens if that client files for bankruptcy in month 9 before you are legally permitted to send the invoice in month 12?
I'm just out of luck.
The risk of non-payment exists the moment the contract asset is generated. And AS 109 demands that you build a probability model to provision for that specific risk of default on your unbilled revenue.
The sheer scope of this standard is staggering. It demands that we hunt for microscopic credit risk in bank deposits, sovereign debt, heavy machinery leases, and even unbilled software milestones.
Nobody escapes the net.
But let's pivot back to our CFO's specific list of safe assets, because this brings us to a fascinating narrative transition.
Yeah.
I understand the stringent rules when dealing with third-party clients, commercial banks, or the open market. The friction is obvious there.
Sure.
But how do these unforgiving rules apply when the entity you're dealing with is inside your own house, when the debtor is a member of your own corporate family?
Intercompany loans. This is where the accounting mechanics often clash violently with operational reality. The family drama of the corporate balance sheet.
The family drama. I love that phrase.
Mm-hmm.
Let's focus on the third item on our hypothetical CFO's query list. Group companies' debtors.
Okay, let's get into it.
I'm going to put my skeptical CFO hat back on, and I'm going to argue this passionately because I know this fight happens in audit rooms every single day.
Oh, it absolutely does. Proceed.
Suppose I am the parent company. I'm highly liquid, sitting on a mountain of cash. I decide to lend 500 million rupees to my wholly owned subsidiary to build a new manufacturing facility.
Okay.
I own 100% of their equity. I appoint their entire board of directors. I literally control their bank accounts.
You hold all the cards.
All of them. If I, the parent, decide I want that 500 million rupees back tomorrow, I don't have to send them a polite collection letter. I just order the subsidiary's finance director to wire the funds. It is entirely within my control.
Right.
Economically, I'm essentially taking money from my left pocket and moving it to my right pocket. Why in the world do I need to waste time and resources calculating an expected credit loss on a loan to myself?
It is an incredibly common, forcefully argued position. We control the cash flow, therefore there is zero credit risk. But here's where we have to peel back the layers and look closely at the legal architecture and the accounting reality that governs financial reporting.
Okay, peel back.
The expert response from the Gap Advisors repository dismantles this left pocket, right pocket theory by layering two very specific foundational standards, Ind AS 27 and Ind AS 8.
Let's take them sequentially to build the argument. The source cites paragraph 9 of Ind AS 27, which deals specifically with separate financial statements.
Yes, this is the crux of the issue right here. Paragraph 9 states unambiguously that separate financial statements shall be prepared in accordance with all applicable Ind AS, except for specific exemptions related to measuring investments in subsidiaries, joint ventures, and associates.
So when you say separate financial statements,
when a parent company publishes its standalone financial statements, we are not talking about the consolidated group view where everything is mashed together, but its own individual, legally distinct entity view. It must follow every single rule of Ind AS as if it were an entirely independent, standalone company transacting with strangers.
oh wow. Okay, so the standard forces the parent to strip away the illusion of family ties entirely.
It does, and then the author layers on paragraph 7 of Ind AS 8, which is the standard governing accounting policies, changes in accounting estimates, and errors.
Okay, and what does that one do?
Paragraph 7 of Ind AS 8 acts as an enforcement mechanism. It dictates that when an Ind AS specifically applies to a transaction, other event, or condition, the accounting policy applied to that item must be determined by applying that specific standard.
Meaning you can't just make up your own rule.
Exactly. You cannot simply invent a customized accounting policy like, hey, we ignore ECL for subsidiaries because we control them just because management feels the relationship is unique. The standard applies universally.
So when we combine Ind AS 27's mandate to treat standalone statements independently with Ind AS 8's mandate that you cannot cherry-pick which rules apply, what is the ultimate conclusion for intercompany loans?
It leads us to a crucial concept regarding what we call common control transactions. The core insight drawn from the author's basis of response is this. Unless there is an explicit carve-out or exemption provided within a specific standard, the stringent requirements of Ind AS apply entirely and forcefully to transactions between entities under common control.
Wow.
The standard is completely indifferent to the fact that they are your subsidiary.
That is brutal. Corporate nepotism essentially does not exist in the eyes of Ind AS 109.
It absolutely ignores corporate nepotism. And if we explore the underlying rationale, if we ask why this matters to the broader financial ecosystem, it actually makes profound sense.
Okay, break it down for me.
Well, a subsidiary is a distinct, legally separated entity. The corporate veil exists for a reason. Let's expand your scenario. The parent company is highly profitable and lends $500 million to the subsidiary to build that factory.
Right.
But let's introduce reality. The project is a total disaster. The local government revokes their permits, the supply chain collapses, and the experimental manufacturing process fails.
A nightmare scenario.
The subsidiary is burning cash at an alarming rate. It becomes legally insolvent. It literally does not have the 500 million rupees to pay back the parent, and it has no assets left to liquidate.
Okay, so if the parent company points to the organizational chart and says, well, we control them, so we're not going to recognize a credit loss on that 500 million, they are presenting a fictional reality to their own standalone investors.
They are presenting a dangerously misleading picture. In the parent's separate, standalone financial statements, if they ignore the ECL calculation, the parent's financial health is artificially and massively inflated.
Because they're claiming an asset that's actually worthless.
Exactly. They are showing an asset, a 500 million rupee loan receivable from the subsidiary at its full amortized cost, when in economic reality that subsidiary is physically incapable of honoring the debt.
And the parent's standalone equity investors or the commercial banks lending money directly to the parent entity based on its standalone balance sheet desperately need to see that reality.
Precisely. Therefore, if the intercompany debtor is measured at amortized cost, or FVOCI, Ind AS 109 mandates that you must run the models and calculate an ECL. The standard is designed to force transparency at the individual entity level, stripping away the camouflage of group consolidation.
Now, that is a phenomenal explanation. It forces the parent company to face the music regarding the actual financial viability of their strategic offshoots, rather than hiding bad decisions behind the shield of group control.
It keeps everyone honest.
By the way, for anyone wondering about the consolidated level, when the parent and subsidiary combine their books to show the whole group's performance, that intercompany loan, and any ECL recorded on it gets entirely eliminated during consolidation anyway.
Yes, exactly. It's a wash for the group view.
But for the standalone view, which is a legally binding document, it is absolutely critical.
That is a very important distinction to make regarding consolidation. The standalone statements serve a different purpose and require strict adherence to the standalone risks.
Okay, so we've established the boundaries. The net catches everyone. Term deposits, sovereign bills, heavy machinery leases, unbilled software contracts, and even the intercompany loans to your own struggling subsidiaries.
Nobody escapes the ECL mandate if they hold a financial asset.
But this brings us to the most daunting part of the deep dive. How do you actually calculate it?
The math.
Yeah, the math. You said earlier we aren't just waiting for a default anymore, so how does a treasury team mathematically divine the future? We need to unpack the mechanics here, because the standard doesn't just casually say, guess how much money you might lose.
Far from it. The mechanism is rigorously mathematically defined, specifically within the framework of paragraph B5.5.28 of Ind AS 109. And the math here is where the rubber meets the road for audit teams.
I have the source text right in front of me. It states, expected credit losses are a probability-weighted estimate of credit losses, i.e., the present value of all cash shortfalls over the expected life of the financial instrument.
That is a dense sentence.
It's super dense. Let's dissect the first part. Probability-weighted estimate.
Right. To truly grasp the complexity of a probability-weighted estimate, we have to look at the architecture of the Ind AS 109 ECL model, which operates on a three-stage approach.
Okay, 3 stages.
Stage 1 is for assets performing normally, where you calculate a 12-month expected credit loss. Stage 2 is for assets that have experienced a significant increase in credit risk, or SICR, where you must calculate a lifetime expected credit loss.
And stage 3.
Stage 3 is for assets that are actually credit impaired, meaning the borrower is in deep trouble.
So the model forces you to constantly monitor the health of the asset and push it into more severe calculation buckets if things start to deteriorate.
Exactly.
But regardless of the stage, how do we calculate the probability weight? Under the old incurred loss model, It was a single scenario outcome, right?
Hmm.
You waited for the trigger event bankruptcy, and then you recorded a 100% loss.
Exactly. In AS 109 abandons the single scenario approach entirely. An ECL is neither a worst-case scenario prediction nor a best-case scenario prediction. It is an evaluation of a spectrum of possibilities, where each potential outcome is assigned a specific, mathematically derived probability.
Let me try to build an analogy here. It makes me think of an agricultural farmer relying on advanced weather forecasting to project their crop yield and revenue.
But I like where this is going.
When the farmer looks at the meteorological data for the harvest season, the forecast doesn't just give a binary "it will rain" or "it will not rain." The meteorologist runs thousands of Monte Carlo computer simulations.
Yeah, like running the models.
They deliver a nuanced probability matrix.
Yeah.
A 30% chance of a severe destructive thunderstorm, a 50% chance of optimal light drizzle all month, and a 20% chance of a severe drought.
Yes.
The smart farmer doesn't just buy fertilizer based solely on the optimal drizzle scenario. They hedge their financial bets across all three probabilities to project their final risk-adjusted revenue.
That is a remarkably accurate analogy for what a corporate treasury department must do. And AS 109 essentially asks you to become the financial meteorologist.
The financial meteorologist, I love that.
You must account for the financial impact of all those economic weather patterns simultaneously. You do not have the luxury of just picking the most likely outcome and ignoring the tail risks.
So how does that look mechanically?
Mechanically, you have to define multiple forward-looking scenarios. You take the financial loss in scenario A, say, a severe economic downturn, and multiply it by its modeled 30% probability. You take the financial loss in scenario B, a stable baseline economy, and multiply it by its 50% probability.
And then scenario C.
You take scenario C, an economic boom with zero loss, and multiply it by 20%. You aggregate those mathematically weighted outcomes, and that blended number is your expected credit loss.
The mathematical intensity of that requirement is just staggering. A large bank or a massive multinational corporation must be running these probability matrices on millions of individual data points.
Millions. It requires massive computational power.
But let's define the actual loss that we are multiplying by these probabilities. The standard refers to it as a cash shortfall.
The standard defines a cash shortfall with absolute precision. A cash shortfall is the difference between the cash flows that are due to an entity in accordance with the legal contract and the cash flows that the entity actually expects to receive in reality.
So if we strip away the complex corporate scenarios and boil it down, if a contract states that a client owes me 100 rupees on December 31st, but based on my probability models, historical default rates, and macroeconomic forecasts, I only expect to successfully collect 90 rupees.
Then your calculated cash shortfall is 10 rupees.
Okay, on a fundamental level, that makes sense.
But here is where we must introduce the formula that auditors and treasury teams actually use to calculate this in the real world. The foundational equation for expected credit loss is ECL equals PD multiplied by LGD multiplied by EAD.
Okay, let's break that formula down piece by piece. PD, LGD, EAD. Start with PDA.
PD stands for probability of default. This is the likelihood that the borrower will fail to meet their obligation over a specific time horizon, either the next 12 months for Stage 1 assets or the lifetime of the asset for Stage 2.
And how do they come up with that number?
To get this number, treasury teams don't just guess. They pull massive amounts of historical data, they look at credit default swap spreads in the market, and they use transition matrices provided by major rating agencies like Moody's or S&P.
Wow, they pull from everywhere.
Yeah, and they have to factor in forward-looking macroeconomic variables. For instance, if the central bank forecasts a drop in GDP, the PD for a corporate loan portfolio will automatically increase in the model.
So the PD is a dynamic, statistically derived percentage representing the chance they simply stop paying.
Exactly. Then we move to LGD, loss given default.
Loss given default.
Correct. LGD is the percentage of the exposure that will actually be lost if a default occurs. It is the severity of the loss.
So if they default, how much do I actually lose?
Right, because if a borrower defaults, you don't necessarily lose 100% of your money. If the loan is unsecured, the LGD might be 80%. But if the loan is heavily secured with prime real estate collateral, the LGD might only be 15% because you can eventually sell the building to recover most of your funds.
Oh, okay.
Evaluating LGD requires analyzing historical recovery rates through the bankruptcy courts, for example, looking at the average recovery timeline and value destruction under the Insolvency and Bankruptcy Code, the IBC, in India.
That makes a lot of sense. The collateral acts as a mitigating factor on the severity of the loss. And finally, EAD, exposure at default.
EAD is the total value that the entity is exposed to at the exact time the borrower defaults. If it's a simple term loan, it's the outstanding principal plus accrued interest.
And if it's more complex?
If it's a revolving credit facility or corporate credit card, the EAD must include an estimate of how much more the borrower will draw down on the facility before they finally default. Borrowers in distress tend to max out their available credit right before they collapse.
That's human nature. Right?
Yeah.
Max out the cards before going under. So you multiply the chance they default, which is PD, by the severity of the loss if they do default, which is LGD, by the total amount of money on the table at that exact moment, which is EAD.
And that gives you the expected credit loss.
But there is one more critical dimension to this that you mentioned earlier. Time. The text says the ECL is the present value of all cash shortfalls.
This is the element that finalizes the calculation. You cannot just use raw future numbers. The standard explicitly states that you must discount those future expected cash shortfalls back to today's rupees.
And how do you discount them?
You must do this using the original effective interest rate of the financial asset.
Let's extrapolate this and walk through a step-by-step mathematical example to see how this actually impacts the safe assets our CFO was complaining about earlier.
Okay, let's bring it back to the CFO.
Let's look at the company's 3-year term deposit. Let's say it's a massive deposit. 1 billion rupees sitting in a highly rated, systematically important national bank earning a 6% interest rate. Most rational human beings would assess the chance of that specific national bank defaulting and wiping out corporate deposits as effectively zero.
A colloquial assessment would say zero, yes.
But
But an Ind AS 109 ECL model must rely on statistical history and systemic risk. Historically, banking systems experience crises. Even highly rated banks carry a non-zero probability of default.
so they had to plug in a number.
Yes. Let's say the Treasury team's model, utilizing sovereign risk premiums and historical banking crisis data, assigns a microscopic 0.05% probability of default, or PD, to that bank over the 3-year horizon.
A 0.05% chance of failure over 3 years. Okay, that's tiny.
Yeah.
And let's assume it's an unsecured corporate deposit, so if the bank does fail and is placed into receivership by the central bank, the loss given default, the LGD, is estimated at 40%.
Right, because the government might bail out retail depositors, but corporate depositors will likely take a haircut.
The exposure at default, EAD, is the 1 billion rupee principal. Let's run the math.
We multiply the components. An EAD of 1 billion rupees multiplied by an LGD of 40% gives us a potential loss severity of 400 million rupees.
Okay, 400 million.
We then multiply that 400 million by our tiny 0.05% probability of default. The resulting probability-weighted cash shortfall is 200,000 rupees.
But we aren't done yet because of the time value requirement. We have to discount that 200,000 rupee future expected shortfall back to present value today, using the deposit's 6% effective interest rate.
Exactly. Assuming for simplicity that the model expects the default risk to manifest at the end of the 3-year term, we discount 200,000 rupees back 3 years at 6%.
And what does that come out to?
The present value comes out to roughly 167,000 rupees.
So let me get this straight. On a quote-unquote risk-free 1 billion rupee deposit at a major national bank, the company must mathematically prove out this microscopic risk and record a 167,000 rupee expected credit loss allowance on their balance sheet today.
They must. The standard simply does not allow them to claim the risk is mathematically zero. They must quantify the friction.
Wow.
And consider the mechanics of how this hits the books. When the company first applies in AS 109, that initial recognition of ECL requires a journal entry. They would debit their retained earnings and credit the ECL allowance account.
Right.
For any ongoing changes in the ECL from period to period, they must run that impact straight through the profit and loss statement. This tiny fraction of modeled risk actively impacts their reported earnings.
It is a profound reflection of the reality that in modern finance, there is no such thing as an absolutely, universally risk-free asset. Every single instrument carries a probability distribution of default, however infinitesimal.
Every single one.
I'm following the logic completely. I see why the net is cast so wide, I understand the complex 3-stage architecture, and I grasp how the PD, LGD, and EAD interact to build the probability-weighted model.
It's a heavy lift, but it's elegant in a way.
But this brings us to the ultimate paradox. This is where we confront the final, most deeply counterintuitive pieces of our CFO's original query. We need to talk about debts owed by government companies and loans backed by secured debtors.
Ah, yes. This is exactly where the tension between management assumptions and accounting standards reaches its absolute peak.
Let me push back hard on this on behalf of our hypothetical CFO, because I know there are Treasury professionals listening to this who are screaming the exact same argument at their speakers right now.
Go ahead, channel the CFO.
Let's isolate the government companies first. We are talking about state-owned enterprises. Governments literally possess the power to print the currency the debt is denominated in.
Very true.
Or at the very least, government-backed companies operate with implicit or explicit sovereign guarantees. They do not go bankrupt in the traditional sense.
That is a very fair assessment of sovereign risk.
And then look at the secured debtor scenario. I've extended a commercial loan to a client, but I hold a legally binding, perfected lien on a physical asset that is appraised at a value significantly higher than the loan itself.
Okay, let's look at the numbers.
Let's use concrete numbers.
Mm-hmm.
I lent the client 100 million rupees to expand their operations. But as collateral, I physically hold a title deed to a prime commercial warehouse that was just appraised at 150 million rupees.
You're sitting pretty.
Exactly. If I know with near 100% certainty that I am eventually going to recover 100% of my principal and my accrued interest, either because the government will inevitably bail out the state-owned enterprise or because I will simply foreclose on the warehouse and sell it for a massive surplus, then my expected credit loss must be zero, right?
It seems like it should be.
If I don't expect to lose a single rupee of principal, how can I mathematically calculate a cash shortfall?
It is the most logical, intuitive objection a CFO can raise. The math seems to suggest a zero loss. But this is where the author of the Gap Advisor's response delivers what I would characterize as the drop the mic moment of the Ind AS 109 framework. He dismantles the CFO's argument not by disputing the eventual recovery of the funds, but by redefining the concept of a loss itself.
Redefining a loss.
He points to the final, incredibly crucial sentence of paragraph B5.5.28. And I want to emphasize every single word of this directive. The standard states, because expected credit losses consider the amount and timing of payments, a credit loss arises even if the entity expects to be paid in full but later than when contractually due.
Whoa! Let me repeat that slowly to make sure the magnitude of that rule sinks in.
Mm-hmm.
A credit loss arises even if the entity expects to be paid in full but later than when contractually due.
I call this the time trap of Ind AS 109. This is where we learn the fundamental, uncompromising lesson that under modern accounting standards, late is mathematically equivalent to loss.
That is a staggering conceptual shift. Let's unpack the specific cost of later. I understand it conceptually, but how does being late translate into a quantifiable numerical loss on the balance sheet if you eventually get all your money back?
It all circles back to the foundational principle of the time value of money, which we discussed earlier when we were defining the interest component of the SPPI test. Let's apply this directly to your government company example.
Okay, the state-owned enterprise.
Suppose a government-backed infrastructure company contractually owes you 100 million rupees on March 31st for heavy machinery you delivered to a massive public works project. You are absolutely certain they are good for the money. State-owned enterprises don't just disappear.
Right, the sovereign backing guarantees the principal.
Yes, but you also know from years of bitter experience that dealing with government bureaucracy is a nightmare.
Oh, defo.
You know, there are countless departmental signatures required, mandatory internal audits of the delivery, budget approvals that get delayed in committee. The red tape is endless.
It's amazing.
Because of this administrative friction, you know they almost never pay on the actual contract date.
Mm-hmm.
In fact, your historical data shows they consistently pay their invoices exactly 6 months late. They always pay in September.
So I have a guaranteed 100 million rupees, but it is guaranteed to arrive 6 months behind schedule.
Exactly. And during those 6 months, you have completely lost the economic utility of that 100 million rupees.
Because I don't have the cash.
Right. If the government had paid you on March 31st, as contractually promised, your Treasury Department could have immediately deployed that capital. You could have put that $100 million into a short-term commercial paper yielding 8% annualized interest for those 6 months.
Or, even more importantly, my operations team could have used that cash to purchase raw materials at a discount to manufacture new machinery and generate a 15% profit margin.
Yes, because you did not have access to the cash you were legally owed, your company suffered a tangible, measurable economic loss.
Ah, I see the mechanism now. Because of the time value of money, receiving 100 million rupees in September is mathematically, objectively worth less than receiving that same 100 million rupees in March.
It just is.
The purchasing power has degraded due to inflation, and the earning potential has been completely squandered over those 6 months.
Precisely. The standard forces you to recognize that degradation. Let's do the math. When you calculate the present value of that 100 million rupees you expect to receive in September, you must discount it back to the contractual due date of March 31st.
Let's assume the original effective interest rate of the transaction was 10%.
Okay. Discounting 100 million back 6 months at an annualized 10% rate means the present value of your expected payment is roughly 95.2 million rupees.
The math exposes the reality. The contractual cash flow due on March 31st was 100 million. The present value of the expected cash flow, the reality of getting paid in September, is only 95.2 million.
Exactly. That 4.8 million rupee difference between the contract and the discounted reality, that difference is your mathematical cash shortfall.
Wow.
That 4.8 million is your expected credit loss, generated entirely by administrative delay.
That is mind-blowing. The standard explicitly forces the company to mathematically penalize the carrying value of the asset simply because of the friction of bureaucratic delays.
And if we apply this exact same uncompromising logic to the secured loan scenario, the illusion of safety shatters completely.
Okay, let's revisit my warehouse example.
You lent 100 million rupees, and you hold a perfected lien on a commercial warehouse appraised at 150 million rupees. From a purely collateral perspective, you are over-collateralized by 50%.
Right.
The borrower suffers a catastrophic business failure and defaults on day one. The contractual cash flows immediately cease. The CFO looks at the appraisal and says, "No problem, we are fully covered. We will seize the warehouse, auction it off, recover our 100 million principal, recover our legal fees, and return the excess to the borrower. Zero ECL."
Right. The collateral covers the exposure entirely. The LGD appears to be zero.
It appears to be zero only if you assume the liquidation happens instantaneously. But Ind AS 109 demands that you model reality. Think about the grim reality of the legal system, particularly when a bank or a lender attempts to enforce collateral rights on a contested commercial property.
It's not quick.
How long does it realistically take to navigate the legal labyrinth? How long does it take to invoke the FVOCI Act or drag the borrower through the debt recovery tribunals, the DRT?
They'll fight it every step of the way.
The borrower will file injunctions. They will dispute the appraisal. They will use every legal maneuver available to delay the seizure. Then, once you finally take physical possession, you have to find a qualified buyer for a massive warehouse in what might be a deeply depressed real estate market.
That's a huge undertaking.
You have to clear the legal title, manage the escrow, and finally eventually get the cash wired into your corporate account.
If we are talking about the real world and a contested commercial foreclosure, that process doesn't take weeks. It takes months. More likely, it takes years. You could be tied up in litigation and asset disposal for 3 or 4 years easily.
Exactly, years. So let's model that reality. Let's say your probability models indicate it will take exactly 3 years of grueling legal battles and marketing to finally sell the warehouse for 150 million.
Okay, 3 years later.
At the end of year 3, the dust settles. You extract your 100 million principal, plus your accrued interest, plus your legal costs. From a purely nominal cash perspective, you are paid in full. But you receive that money 3 entire years later than the original loan contract stipulated.
And during those 3 years, that 100 million rupees was dead money. It wasn't earning interest, it wasn't funding operations, it was just trapped in a legal battle.
Precisely. The present value of 100 million rupees received 3 years late is catastrophically lower than the contractual expectation.
Yeah.
If your effective interest rate was 10%, The present value of receiving that cash in year 3 drops to roughly 75 million rupees.
Wow.
That massive 25 million rupee gap between the contractual expectation and the time-delayed reality creates a severe cash shortfall in present value terms. Which means, returning to the core of the standard, even with collateral that is appraised at significantly more than the loan value, an expected credit loss allowance is absolutely required on day 1 to account for the probability-weighted time delay in actually realizing the cash from that collateral.
I have to say, seeing the mechanics laid bare like this completely transforms how you look at a balance sheet.
It really pulls the curtain back, doesn't it?
It does. If we connect this back to the listener, particularly the investor we talked about at the very beginning of the deep dive, this is precisely why understanding the depth of this standard is your ultimate shield.
Without a doubt.
If you are deploying your hard-earned capital by investing in a publicly listed company, you desperately want their management team to be aggressively, mathematically realistic about when cash is actually hitting the bank account.
You want them grounded in empirical reality, not optimistic projections?
Exactly. You do not want a management team living in a fantasy world where eventually getting paid by the government is treated on the balance sheet exactly the same as having the cash in our hands today, because eventually doesn't pay dividends and eventually doesn't fund research and development.
And AS 109 is designed to strip away that corporate optimism. It forces management and auditors to meticulously quantify the friction of reality.
The friction of reality.
The bureaucracy of state-owned enterprises, the crushing delays of the legal system, the infinitesimal systemic risks inherent in the banking sector. These are real, tangible frictions that destroy economic value over time.
They really do.
The standard ensures that the balance sheet reflects the cost of that friction, rather than presenting a sterile fantasy of perfect contractual compliance.
Quantify the friction of reality. That is a brilliant way to summarize the entire framework. And I think it completely comprehensively answers the query from our hypothetical CFO. Do they need to calculate and provide an expected credit loss allowance on their portfolio of seemingly safe assets? On term deposits, treasury bills, intercompany group debts, government debts, and fully secured loans.
Yes, a resounding mathematically verified yes.
Because absolutely no financial asset is immune to the destructive friction of time and the unavoidable distribution of probability.
It is a comprehensive, practically unavoidable net. But it serves a vital purpose. It makes financial reporting vastly more accurate, more predictive, and ultimately more trustworthy for every stakeholder involved in the capital markets.
This has been an incredibly enlightening journey through the muddy, complex waters of financial asset valuation. It really shifts the paradigm on how you view the concept of financial security.
It certainly redefines security in mathematical terms. And, before we wrap up, I want to leave our listeners with a final, slightly provocative thought to mull over.
Oh, I like those. Lay it on us.
We've spent this time discussing how Ind AS 109 forces massive corporations and banks to rigorously mathematically account for the cost of late. They are legally required to recognize that delayed money is, in a very real sense, lost money.
Right.
So my question to the listener is this. How much hidden, unrecorded time delay loss exists in the everyday contracts and informal agreements we make in our own personal and professional lives?
Oh, wow. Taking the corporate standard and applying it to personal finance. That is a fascinating angle.
Think about the friend who borrows a significant sum and always pays you back a month late, or the freelance client who routinely stretches their net 30 payment terms into 90 or 120 days.
We usually just brush it off as an administrative annoyance as long as the check eventually clears.
But the mechanics of Ind AS 109 prove mathematically that time truly is money. And in the corporate world, the degradation of that time is a mandatory, highly visible line item on the balance sheet. Perhaps we should all be a bit more rigorous about valuing the timing of our own personal cash flows and recognizing the hidden losses we absorb when people don't respect our time.
That is something that will definitely linger with me the next time I lend out a few bucks or the next time I sign a freelance contract. I will be calculating my own personal ECL from now on.
Might save you some grief.
I cannot thank you enough for guiding us through this incredibly dense, highly technical, but fundamentally fascinating topic.
It was my absolute pleasure.
And to you, the listener, I want to warmly thank you for dedicating your time to learning with us today. Navigating the depths of accounting standards is not easy, but your curiosity and dedication to understanding the truth behind the numbers is what makes this show possible.
It really is a privilege to unpack these complex structural issues for an audience that genuinely cares about understanding the mechanics beneath the surface of corporate finance.
If you found the analysis in today's deep dive valuable, I strongly request that you follow or subscribe to the Gap Advisors Ind AS Clinic podcasts. We want to make sure you have access to this information wherever you are, so we are available on Spotify, on Amazon Music, and on YouTube.
So many options.
Please, go ahead and choose whichever platform you prefer to listen to Gap Advisors Ind AS Clinic podcasts on. And hit that subscribe button so you never miss a deep dive.
And please do not keep this knowledge to yourself. The financial world is complex and often opaque. We need to actively help each other navigate it.
Absolutely. We are issuing a formal sharing mandate. Please share this deep dive among your professional contacts, your colleagues, and definitely within your internal audit and finance teams.
Let them hear the math.
And I want to make a very special targeted plea. If you know any students who are currently pursuing the CA course, please share this with them. Spreading this precise, real-world knowledge on the rigorous application of Indian accounting standards is absolutely vital for equipping the next generation of finance professionals.
They really are the future.
They are the future guardians of our financial reality, and they need to know early on that the simple, clean bank statement.
Well, it is very often just an illusion masking a complex web of probabilities.
Until next time, keep digging into the models and keep questioning the numbers.
We'll see you on the next deep dive.